Welcome back to Investing Talk Podcast.
Today we're looking at Centene. The big question is it a good time to buy now?
That's the mission. We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Centene is, well, it's arguably one of the most structurally complex stories in healthcare right now.
Complex how?
Primarily because the financial statements are presenting just a stunning paradox. It's confusing at first glance.
Okay, a paradox. That sounds like the perfect place to start. So on one side, the revenue story looks, frankly, incredible.
It really does.
Centene just reported Q3 2025 revenue that didn't just meet expectations. It beat them pretty handily.
Yeah, and analysts are projecting really robust future growth, too.
Right. Consensus forecasts for the full year 2025 are now pushing, what, almost $193 billion?
Around $192.74 billion, yeah. Building substantially on that strong 2024 growth.
Which was already solid, about 4% year over year, bringing in over $147 billion.
Exactly. Strong revenue fundamentals like that, they usually scream buy.
But there's always a but, isn't there?
There is. When you, the investor, look at that headline, Q3 2025 earnings release, you see, a terrifying number.
Which was?
A reported GAAP diluted EPS loss of negative $13.50 per share. Negative $13.50.
Wow. Okay, yeah, that is a headline designed to scare money away. So GAAP. That's the standard accounting rules, right? Generally
accepted accounting principles, yes. The standard rules for public reporting.
Why did those rules force Centene to report such a massive loss?
Yeah, it's really crucial to understand why. That $13.50 loss was almost entirely driven by substantial non-recurring one-time charges.
One-time stuff, like what?
Think cleanup costs, divestiture charges from selling off parts of the business, legal settlements tied to older operational issues.
Okay, so it's basically the company clearing the decks, dealing with past baggage.
Exactly. It's painful financially in the short term, sure, but those charges, they're not really indicative of their current day-to-day business health.
So the challenge for us and for you listening is to look beyond that huge one-time hit and find the true operational signal. What did the company really earn if we strip away yesterday's mess?
Right. And if you look at the company's adjusted profitability, the picture just flips entirely.
Okay.
Centene reported an adjusted EPS of positive $0.50, 50 cents per share.
Positive 50 cents versus negative $13.50. That's quite a difference.
It is. And that 50 cents, that is the critical number here. It demonstrates that the core function managing health plans for government programs, it's not only profitable, but actually highly resilient.
So management's been focusing on efficiency.
Laser focused. Tightening spending across the board, which is helping support those adjusted margins, even when things are, a bit tough economically.
Okay, that helps clarify the earnings confusion. But managed care, it's not just about profit per share, right? Stability, balance sheet strength, those are paramount, especially with government contracts where cash flows can be a bit cyclical sometimes.
Absolutely predictable.
So how robust is the foundation when we look past the P&L?
Exceptionally robust, actually. Centene's balance sheet health looks solid. They maintain strong liquidity heading into late 2025.
And the debt?
It seems manageable relative to their assets. If you look at the 2024 year-end figures we pulled, total debt was about $17.2 billion.
Right.
But total equity was significantly higher. $25.1 billion. Good cushion there.
And the cash generation, I remember seeing some numbers in the sources that were pretty eye-watering.
Oh, absolutely. That's really the ultimate measure of their underlying health.
Yeah.
Centene generated, get this, $8.56 billion in operating cash flow in fiscal year 2024.
$8.5 billion. Wow.
Yeah, that is an enormous amount of liquidity. It gives them immense flexibility.
Flexibility for what, though? They don't pay a dividend, right?
Correct. No dividend currently. That's not their priority. But that kind of cash generation, it provides significant capital return optionality.
Meaning?
Meaning when they decide the time is right, they could easily initiate serious share buyback programs.
Which would naturally boost the remaining stock price by reducing the share count.
Exactly. It's an option they definitely have in their back pocket thanks to that strong cash flow.
Okay, let's unpack their competitive position a bit. Managed care, it feels like a crowded sector, yet Centene maintains this dominant position. What gives them that structural moat that rivals can't easily breach?
It really comes down to two things, scale and specialization. specifically within the public sector.
So they're not trying to be everything to everyone.
Not at all. They're focused primarily on these essential and, importantly, growing patient bases: Medicaid, Medicare, and the ACA marketplace.
ACA being the Affordable Care Act exchanges.
Correct. And their structural moat is built on being the largest Medicaid managed care organization in the U.S. by both membership and revenue.
Okay, being the biggest Medicaid player, that sounds impressive, but how does that translate into actual business advantages? It's not just bragging rights, right?
Definitely not just bragging rights. It translates into three main things.
Right.
First, cost negotiation power.
How so?
Their massive scale allows them to negotiate preferential reimbursement rates with huge networks of providers, doctors, hospitals, clinics, rates that, frankly, smaller competitors just can't get access to.
So they get better deals because they bring more patients to the table. Simple as that.
Pretty much. This drives efficient cost management and really helps secure their margins.
Makes sense. What's the second advantage?
Contract stability and retention. Medicaid contracts are, long-term, they're lucrative, but they're often fiercely competitive to win in the first place.
Right. States put these out to bid.
Exactly. Centene's existing national footprint, their deep experience across dozens of states, it gives them a kind of preferential status in contract renewals and helps with regulatory compliance. They just have higher retention rates because they know the game.
They already know the nuances of, what, like 30-plus state programs?
Something like that, yeah. They're embedded.
Okay. Negotiation power, retention. What's the third factor?
It's more strategic, maybe. Political and demographic alignment. They are just perfectly positioned to capture these big, long-term industry tailwinds.
Tailwinds
Like rising demand for public health programs.
Mm-hmm.
Think about an aging population needing more Medicare or, economic shifts that expand Medicaid enrollment. Centene is the established infrastructure ready to capture those gains.
And that specialization kind of shields them from some of the intense competition in the commercial insurance market.
Somewhat, yes. They have carved out a very strong niche.
Okay, that makes the fundamental picture pretty compelling, despite the headline earnings noise. Now let's see if the market actually, recognizes this strength. What happened to the stock price right after that confusing Q3 report came out?
Well, the market clearly ignored the gap loss and focused entirely on the adjusted profit beat and that strong revenue.
So it reacted positively.
Very positively. Following the earnings announcement, which was October 29th, 2025, the stock surged dramatically. It posted nearly a 10% gain in pre-market trading.
Wow. Okay.
And it broke decisively above some near-term technical resistance around $33.20.
So that initial surge, it confirms that the big money, the institutions, they were focused on the operational signal, not the accounting noise.
It certainly seems that way.
But did that strength hold up, or was it just a quick pop? What does the current technical picture tell us now?
Well, the technical picture actually remains strongly bullish.
Okay, how so?
The stock is currently trading above both its 50-day and its 200-day simple moving averages.
And for you, the investor listening, that's kind of the classic confirmation that the trend is moving upward, right?
Exactly. It suggests the short-term enthusiasm has settled into more sustained buying pressure.
That sustained pressure is key. If it just surged and then stalled out, that might just be short covering or quick profit taking.
Right. But we're seeing follow-through.
What about momentum indicators? Are they like flashing warning signs of being overbought?
Not yet, which is encouraging. They reinforce the momentum without showing signs of overheating. The RSI, the Relative Strength Index, is sitting pretty healthily in the 58 to 62 range.
Which is strong but not extreme.
Exactly. Strong momentum, but suggests there's still potentially room to run. And similarly, the MACD indicator.
The moving average convergence divergence, always a mouthful.
Ah, yes. That's also posted positive readings, confirming a bullish crossover signal.
So the charts, the technicals, they seem to be confirming that the fundamentals we just talked about are actually being priced in by the market now.
It appears so, yes.
If this rally holds, what's the next sort of major target zone analysts are watching?
Well, our 3-month kind of bullish outlook targets the $37 to $39 resistance band.
$37 to $39?
Yeah, that's the psychological and technical threshold the stock will likely need to breach next to continue the uptrend.
And on the downside, if things wobble, where's the support?
Critical support seems to sit pretty firmly down between $31 and $32.
Okay, good levels to keep in mind. And one last technical point from the sources. The stock's volatility, measured by beta, is reported at a relatively low 0.48.
Yes, which is interesting. It simply means the stock tends to move only about half as much, on average, as the overall market, like the S&P 500.
So less jumpy than the market average.
Correct. So for investors maybe looking for a degree of stability, even with this kind of growth potential tied to those secular trends, that low beta might be quite attractive.
Okay, let's shift focus now to what could be the immediate drivers, the catalysts we need to watch in, say, the next 3 months, both good and bad.
Right. Well, the single biggest near-term catalyst, no question, is the Q4 earnings report. That should be coming out in late January 2026.
And what are investors looking for there? Just the numbers.
More than just the performance numbers this time. They are, I'd say, desperately seeking clarity on the 2026 outlook guidance and the projected margin trajectory. Where are margins headed?
And that brings us right to the elephant in the room risk, doesn't it? The guidance withdrawal.
It does.
If the financials in the business model are so robust, as you've laid out, why did management struggle so much with visibility earlier this year that they actually had to withdraw their formal 2025 guidance? Doesn't that suggest maybe a serious underlying operational problem they weren't telling us about?
That withdrawal is absolutely the source of the market's remaining uncertainty. And you're right to challenge it. It's a major earnings visibility risk.
So it was a legitimate concern.
Oh, absolutely. It was, in fact, the primary reason Deutsche Bank cited when they put that short-term catalyst called sell rating on Centene recently.
Okay.
They felt that lack of clarity, it temporarily outweighed the strong revenue trends. So Q4 has to deliver a clean sheet, basically. Solid, clear guidance for 2026 is needed to dispel that cloud.
Got it. So Q4 earnings and guidance are huge. Beyond that pivotal report, what other potential good news could move the needle pretty quickly?
Medicaid contract awards. This is the absolute lifeblood of Centene.
Right, those state contracts.
Exactly. States constantly put out these large requests for proposals, RFPs, for their managed care contracts. Several major state Medicaid RFPs are pending right now.
And if Centene wins some big ones.
If they secure a few large wins, it would drive immediate, significant enrollment and revenue upside. It's a direct growth driver that can act as an instant stock catalyst. Boom, good news.
Okay, contract wins. And we also need to keep tabs on what the big institutional players are doing, right? The Vanguards and BlackRocks of the world.
Exactly. We'll get a flood of insight there in January 2026 when the institutional 13F filings are released.
Those show who bought and sold what in the previous quarter.
Precisely. They show us exactly what those behemoths were doing. Are they maintaining their long-term conviction in Centene, or are they trimming their positions? It gives us a picture of, smart money sentiment.
And anything else on the institutional front?
Well, less impactful maybe, but ETF rebalancing, particularly back in November 2025, could cause some short-term volume spikes or flows that are worth noting.
Okay, we've covered the guidance risk pretty well, but what about the broader sort of systemic risks facing a company so tightly linked to government programs?
Yeah, the biggest one there is always regulatory and policy risk. Centene operates in a sector that is just heavily influenced by decisions made in Washington, D.C. and in state capitals.
So changes in laws or rules?
Any major legislative shifts in healthcare policy, especially changes to Medicaid reimbursement rates, how much they get paid, or any big restructuring of the ACA marketplaces, those could directly impact Centene's revenue and margins.
So they have to constantly lobby and adapt.
Constantly. It's a shifting political landscape they have to navigate.
Which means that while they benefit from that big secular trend towards public sector healthcare,
they also carry the political risk that comes baked into it.
Precisely. And does that lead to other risks, like margin pressure?
It does. It leads directly to margin sensitivity risk. Centene relies heavily on its scale and that efficient cost management we talked about to keep profitability high. So if there are unexpected changes in how much they get reimbursed by the government, or maybe if the overall health complexity, the acuity they call it, of their member base increases rapidly, meaning sicker patients.
And costs go up.
Costs go up, and those margins could come under severe pressure. Managing the costs of potentially sicker populations while still meeting all the state standards, it's a constant balancing act for them.
Okay, so having weighed the structural moat, the strong cash generation, the bullish technicals, but also these significant risks tied to guidance and policy, Where does the broad market sentiment actually land right now? What are analysts saying overall?
Well, overall, the analyst consensus is technically a hold.
Which sounds kind of neutral, maybe even negative.
It often gets misread that way, yeah.
Hmm.
But if you dig deeper, the median 12-month price target is around $37.07.
$37. And from recent prices, that represents what, about 12% upside?
Roughly, yes. About 12% upside potential baked into that hold rating.
Mhm.
But what's truly fascinating is the huge dispersion in targets.
Meaning some analysts are way more bullish.
Way more bullish. The high target out there sits all the way up at $61. $61.
Wow, that's a huge difference from the median.
It is. And it indicates that if Centene can clean up its guidance visibility in Q4, some analysts see massive potential for a significant re-rating of the stock.
And as you mentioned earlier, the big institutional giants, they seem to be staying put for now.
Yes. The data we have shows major institutional holders like Vanguard, BlackRock. They're largely maintaining or even adding slightly to their stakes.
Which signals what?
It signals they're likely looking past the short-term accounting noise, past the guidance hiccup, and they're focusing on that multi-year structural advantage Centene holds in public health insurance. They're playing the long game.
Right. We probably can't close without briefly touching on any speculative rumors out there, because in managed care, there's always chatter, isn't there?
Oh, indeed. There always is.
Right.
We've certainly seen rumors circulating regarding potential strategic divestitures of some non-core assets.
Selling off parts of the business that aren't central.
Exactly. Selling those off would streamline the business, maybe boost capital, and allow the company to focus even more sharply on its core Medicaid and marketplace segments.
Makes sense. Any M&A talk?
There's always ongoing speculation about possible M&A activity, either Centene acquiring smaller players or perhaps even being targeted itself. And you occasionally see talk in the financial press about potential activist investor involvement.
Activists pushing for changes?
Pushing for governance changes, operational improvements, maybe even a sale. Now, these are just rumors, right? We have to stress that.
Of course.
But they definitely add a little bit of speculative fuel to the bullish fire, should any of them actually materialize down the road.
Okay, so let's bring it all together. What's the final investment thesis for you, the listener, after weighing all this?
Well, when we put together the strong underlying fundamentals, that proven cash generation capability, the positive technical confirmation we're seeing now, and those key near-term catalysts, all combined with that massive long-term structural positioning in public sector healthcare, we'd assign an overall bullish rating, maybe an 8.5 out of 10.
An 8.5, that's pretty strong. And it sounds like it gives the stock appeal on multiple fronts.
I think so. It looks potentially attractive for shorter-term trading, maybe trying to leverage upcoming contract news or that post-earnings momentum if guidance is good.
But also for the long haul.
Yes, but fundamentally, it still seems like a solid long-term investment aimed squarely at capturing that powerful secular growth trend in government-backed healthcare over many years.
So the final thought really circles back to Q4 earnings, doesn't it?
Absolutely. The pivotal event you absolutely must watch, the one that will either confirm this recent rally and unlock more upside or potentially send the stock back into uncertainty, is that Q4 earnings report, expected in late January 2026.
That's the moment of truth.
That's what should validate the recent bullish technicals, hopefully solidify the operational cleanup narrative, and crucially provide the necessary clarity on the path forward, especially after that guidance withdrawal really spooked the street earlier this year. Q4 guidance is key.